and welcome to the Trading Zone. I am Joe Teague of Equity Armor Investments. Hope you had a great weekend and are off to a great start for the trading week. With me, of course, as you can see, Brian Stutland, also of Equity Armor Investments. Brian, how you doing? How was your weekend?
Good. We got our first snowfall of 2025 here. Snow sitting on the grounds for a big part of the north area, from Chicago to New York. So people feeling probably a little chilly. Winter is here, Game of Thrones style, but that doesn't mean the markets are cooling off, I don't think, right?
Absolutely not. Market is hot this morning, to say the least. Although last week we were cold. You know, we've been talking about this for some times, Brian. We've been saying, if you've been following along with our show, you should expect some volatility. We're in the midst of this big rally. There's no denying that. But while the market is rallying, we should expect some volatility. And over the weekend, I know your Bears somehow managed to squeak out another win. They seemingly are able to beat all these mediocre teams just barely, but great job for the Bears. 6 wins for you guys. But I follow, the real kings of the North. Speaking of winter is coming, the Detroit Lions. But it's so fascinating. You follow them. The ebbs and flows, the media will make you think of the season. Week 1, we lost to the Packers. We were terrible. Season over. Week 3, we've had 2 straight wins. We beat Baltimore, and it's like, oh wow, we're a Super Bowl team. And then we lose to the Vikings, and it's like, these guys suck again. And we have 1 good week last week. Again, it's like, oh, you guys are the greatest thing ever. That's exactly what the stock market does too. Last week, for whatever reason, we were lower. Yes, we had the shutdown, but that shutdown was kind of there before. Turning around today to, hey, things are so great today. That's kind of the bottom line is, if you follow anything with media, if it bleeds, it leads. They want to scare you. And by the way, I'm a risk manager by trade. I should be the guy wanting to scare you to get you to invest in my fund, but instead I want to give you the truth. I want to give you the way I really feel about the market. So that is the bottom line here. I think there's a lot of noise out there. People are talking about the Hindenburg omen. People are talking about the Titanic omen, all these scary things. The amount of time we're above the 50-day moving average. Yeah, there's going to be some volatility. That's the bottom line is, but you got to have the right plan to be able to stomach the volatility out.
Yeah. Well, when we take it, speaking of volatility,
that was the ripple effect plug. I brought it up there. Check it out at Equity Armor Investments, equityarmorinvestments.com. Subscribe. That's for free. While you're there, you can look into the Trading Zone, and you can get trades, which we will show you an example of. One of the trades that went out to our subscribers this morning at the end of the show. Stick around for that. You won't want to miss it.
Yeah. Well, when you look at volatility here, I just want to get into our volatility space. That's our specialty. Joe, you and I many years trading in the VIX pit, making markets on options and VIX and volatility. And when you look at this, we know there's an ebb and flow of volatility that creeps into the marketplace. You may get a resting heartbeat for a little while, but then you start to exercise and work out, and maybe you have some anxiety and you panic, and heart rate goes up. And we did finally see a little bit of that recently. Now the question is, does that bleed into more volatility? Does it ripple into other areas of the market? I've seen a lot online, people talking about SOFR, the rate, which is basically banks lending to each other overnight relative to the rate that the Federal Reserve is at. And okay, yes, SOFR has ticked down, but I mean, the Fed cut rates. It should move with interest rates. Now, that created some bond volatility, right? To the upside, right? Bonds rallying, interest rates coming down. That created some volatility in the bond market. And we've said, is that something to worry about? Yeah. We get above this 80 level, let's say in the MOVE index, and I start to worry that maybe valuations are a little lofty. Maybe there's a little bit of lack of liquidity in the system somewhere else going on. For now, I don't believe in it. I would kind of ignore that noise right now. That's not where concern is coming from. I think concern is coming from whether valuations are, and whether the economy is kind of slowing down, the job market getting worse, and then obviously the crux of inflation creeping in at the same time. So that's the real concern, not a credit concern right now, at least for me.
Yeah, I we'll couple that. Say 100%. I agree with you. For me, right now, it is more macro on the economy side. We're gonna get some data finally. Once the government does reopen, that'll be big. It'll be to see will the Fed actually be cutting more, and how healthy is the economy. I think that'll be really important to see when that does come through. I think all signs last week were, yes, we had a little bit of a hiccup in volatility, but it wasn't anything blowing out of proportion. The move index kind of showed that to me. Same with this skew index. The skew index was not saying anything crazy. In fact, people might have been selling some puts last week, just keeping this skew index under wraps here. Not seeing a ton of movement here, not showing any panic from any volatility buyers.
Yeah, I mean, one thing you can take away from this vol move is when you look at the skew here, we see it, continue to rise a little bit. So obviously there's some worry on the downside, put buyers coming in once we get a little bit of a rally. But when you turn the page here, Joe, and look at the VIX futures market, we kind of mean reverted, right? I mean, we're kind of back in between where we were a month ago and where we were 2 months ago. So it's interesting how volatility finds its way back to the middle grounds at some point. And I would say the market bounced those that we saw. Obviously, some news that the government's going to reopen maybe sooner rather than later. Got this rally going late afternoon on Friday into this morning.
Right,
yeah. So I think right now, let's watch this. Let's see where VIX futures go. If they start ticking back up toward the line, which is where they were a month ago, then you got to say to yourself, wait, there's maybe some more selling to go, and we kind of move out of this range. If it likewise comes back down to where it was 2 months ago when we had this good feeling in the market, then that's probably a bull sign. So I think we're kind of in the middle. I'm not ready to make a call one way or the other in the direction of the market here. I think it's going to take a break for maybe a day or two and then sort of play itself out after this week.
Yeah, no question about that. Let's get into the week, as you mentioned, Brian. Volatility showed up last week. It's down that week. Today, it's still somewhat elevated. We all think the shutdown will be over when the House gets together. I think there's no reason to think otherwise. When the government data comes through, probably next week, we'll be waiting for that eagerly. And again, more earnings will be coming. The earnings have been the most important story for me, Brian. Yes, valuations were super high. Earnings exceeded these high valuations, and we still didn't get a bigger rally. That's kind of a sign of consolidation here for me, Brian. Some of these stocks are catching up to their price, which is really good news. Stock like Palantir comes to mind. Of course, having a great day today. Owners love to see it for Palantir, but it had a record earnings, record beat earnings, just incredible across the board. And because its valuation was so high, it had a hard time rallying after its earning. That doesn't bother me at all. It's more important to me to see the company continue to grow, continue to guide higher. They do that quarter after quarter. The price will take care of itself. And right now, it's just nice to see that it's comfortable up here at near $200 a share for Palantir. But anyways, looking out at the rest of the market, very similar story. And Google maybe leading the charge in terms of earnings, showing, hey, we can make money on these data centers. We need to build more of these data centers. That is the big story that we're going to get into in a second, is this data center build out. Amazon, same story, doing fantastic on their web services. So that for me is what this rally has been all about. Buying chips for these data centers, getting ready for the continual evolution of this AI narrative. NASDAQ.
The brain continues.
Yeah.
The brain continues to be, developed. Data centers continue to be built. It's a massive, massive industry right now. You look at the NASDAQ there. I think chart, Joe, I would maybe, if I had to of that chart, right? It's like forming like what technicals call a flag formation. Make a little bit of a lower high. We make a little bit of a higher low, pull back again, maybe giving, and then, then figure out a break to go higher from there. So there's nothing in that like chart technically that says we're going lower, and then there's maybe nothing in there that says we're going significantly higher just yet is the one thing. I mean, we got a nice like retest of call it early October, sort of the up movement. We've kind of come back to where it broke out, gave things back, but we kind of successfully held that level. So again, I think we're in this middle ground part of the market right here where seasonality should take care, but there's some underpinning things that make us want to feel like we should go lower, especially on the valuation side. So just take a few days of take a break and consolidate a little bit more.
Yeah, we'll see how it plays out. For me, it's just the liquidity. The liquidity is in the market. That's why the move index is so low. You mentioned SOFR earlier. That's just the QT kind of ending, the Fed pouring more money. But it's not only the Fed. It's like central banks all around the world are pumping money into the economy. That's why gold did what it did, had its blow off top, and maybe now we're recovering again. That's why everything is just kind of inflating here. So just something to watch out for. There's a big tailwind behind these equity markets just because the liquidity is just pushing things higher. Doesn't make sense to really fight it until the economic narrative changes, which the data might show that in a week. So we'll be carefully watching out for that. Of course, not surprising, semiconductors, big bounce back today. A lot of damage last week, but that's just the nature of the beast when you get this like high flying vehicle here. You should expect this turbulence, to go back to the flying metaphor. You should expect these bumps in the road. Yeah. No question about it. Same thing's happening here in the Mag 7. All these charts are kind of telling the same story. Great day today. We're not out of the pain yet. We're not out of the woods yet. We obviously need to see a higher high to have like a green light here on the markets. But the bigger picture just continues to be the narrative of the AI trade being on, and the AI trade still having a lot of momentum. Now, we talk about this like almost every show, Brian. People still keep on just shouting, hey, this is a bubble. This is a bubble. Everybody be warned. This is a bubble. Well, if we were in a bubble here in 95, like there are worse fates than to be in the market for the next 3 years here, right? To be a part of this.
Yeah, for sure. Look, yeah, we could be in a bubble, but we looked at earnings, right, Joe? I think you and I would both agree that Amazon earnings really good, Palantir earnings really good. Oracle's were even okay, even though that stock's like given basically everything back since they announced $300 billion of using their cloud services deal. So there could be issues with everybody spending on data centers. It's paying off. So far it's paying off. So I think we still could be in the early of all this.
Yeah, Amazon's fastest growing segment is AWS. Google's fastest growing is their cloud services. So if they're spending money to grow that and they're beating expectations on their bottom line in the cloud, that just seems like they are right. They're doing the correct thing in spending this money. But here's here's where people are kind of saying, hey, this is a problem. This is a bubble. This is not sustainable. And to their point, and here's like I'll play devil's advocate here for us, Brian. If you're looking at this chart, you're going to say, this doesn't make sense. Oracle, taking on these massive loans here, just bigger than anything we've seen in the past decade here. This spending from debt that we're seeing just doesn't make any sense. They're building out all of this data center capacity. They don't know if it's actually going to be profitable in them. If it's not profitable, how are they going to pay these loans back? That seems to be like the case that this is a bubble forming right now.
If it does feel like that, but I think there's profitability at the end of the road. So when we talk about bubbles, it's usually when the credit's gone wrong and you've had to pay these loans back and you can't make payment. And we're not at that point right now. We're taking loans to try and see if this plays out and works. That's where we're at in the game and the stage. So it's okay to take loans with, this is capitalism at its finest, right? You speculate on whether something is a good business idea or not. You act entrepreneurial towards that. And that's the loan distribution that we're seeing right now. In fact, this could be actually inflationary, if anything, and growing faster, which is sort of the realm that we're in, because if the data center build out works, and I think there are signs that it is, that it becomes profitable, that it's a hugely successful program and there is no credit concerns about it. And then who cares if they're spending a lot on it? If you spend to make, then you're okay.
Yeah. And for me though, this is if they are right that these loans are going to go bad, For me, though, maybe that's true, and that actually was what happened here in this part here, Brian. There was a lot of data built. There was not data centers, but it was physical lines being built all across the United States, broadband lines being built everywhere. Ironically, Oracle was a part of that back then. Maybe that's another parallel going on. But this was something that was just lines kind of being built out from city to city, but also out to some rural areas. Maybe they didn't need to be built in areas where they were built, and they weren't being owned by a physical company. It wasn't. It was just kind of being built out into the grid and saying, "Hey, we'll profit off of it somehow, some way later." This seems more direct ownership, where these hyperscalers have ownership of these data centers. They're not, they know where they are. They know what's going on there. Maybe there's a worry that, there's a small use case for these NVIDIA computers, and after a year, they're going to be worthless. I don't think that's the case. I think there is a year's worth of training capability on the NVIDIA chips. And then after a year, there's a second life for these chips where they can serve as cloud backup and cloud storage and everything else the cloud needs to do, which is continually growing. So but anyways, this seems to me like the inflationary part of this bubble. You need to spend this money. This money does go back out into the system, by the way. Every chip that's bought by NVIDIA, they need to be built somewhere. They're building enormous gigafactories in Texas and Arizona. Intel, huge factory coming up in Ohio. So there is physical spending going on building this out right now that is going into the economy in other areas too. It is worrisome, but this money is being borrowed now. If it doesn't turn out to be a profitable investment, we'll be learning about that in 2 to 3 years. And that could be.
Yeah, it should be interesting. Yeah. It should be interesting. I don't think the story. I think the story ends a little bit differently. If I wanted to predict out a couple years about how the spending is going to play out, I think the spending works. I think profitability becomes tremendous. I think where it goes bad actually is the fact that robotics and AI will have a massive deflationary effect, right? They're going to be able to perform jobs that we are doing today, which is going to shift people into other areas of the economy. The economy will find massive production, but not necessarily massive new money to be made. What goes bad is when there's shakeout of a massive deflationary effect on currency. And on the back end, when robotics really builds out and take over all kinds of parts of the economy, when AI starts to perform all kinds of tasks that can be done right now by people that will no longer be needed. And when that happens, that I think is when the bubble bursts, because it bursts on a massive effect on a credit situation. No two things happen twice. They can kind of happen similar in periods of time. The technicals can look the same on the charts, but I think the reasoning is going to be different this time.
Yeah, for me, bottom line is the economy slows down. This all becomes a lot harder. These are high valuations because there is high expectations for this to all work. Slowing economy down is going to slow the corporate earnings down. It's going to make these valuations too high. It's just the bottom line. So that needs to maintain. That's what needs to be maintained. To your point, though, I think I'm kind of not quite there where this is going to be completely deflationary, completely take away all jobs. I think there's a lot of specific jobs which AI can do and replace very quickly. But I would hesitate to say all of them, at least for the next 10, 15 years. But I don't know. The rate of change is happening faster than I expected. Us options traders know that as the gamma. So the gamma of the tech just continues to be really high. So one of the companies, by the way, that's doing a lot of this change, Brian, is Tesla. They just had a big board approval last week. Elon's going to get paid. Almost sounds crazy, but his pay package is worth $1 trillion. But it's only worth $1 trillion if the company exceeds or meets some critical milestones. Obviously, includes driverless cars and robots, physical robots. And I think that's the exciting thing. It's, if you think of it as a tech company, finally it's turning the corner from a car company to a tech company. It is going to be the physical manifestation of AI. I think that's what people are really waiting to see in this world. Like, okay, yeah, it's cool to talk to ChatGPT and ask it for advice on relationships, or maybe whatever, something I don't want to ask a friend or embarrassed to ask a person. But what's something in real life I can have? Could I have like someone in my house doing chores, like cleaning up after the kids or laundry or cooking even? Is there some physical AI that's out there? That would be cool. I don't know how soon that is, but to pair the brain of the high-speed like chip processing power with something physical, manufactured it. Tesla's in perfect spot to do that. They have the manufacturing and they have the AI going on with it too.
Yeah, I mean, you're starting to see other competitors emerge. There's a couple other robotic firms out there right now, more on the private sector side. Tesla being the public company with supposedly to launch 3.0, 4.0 potentially in the next year or two. We did see Elon Musk come on the Joe Rogan podcast stating about the Tesla Roadster maybe being a car that could be a actual flying car. At least he hinted to that. See in the first quarter of next year. So really some exciting things to happen with this. Admittedly, we have Tesla for clients, right, Joe? I would say it's be about equal weight than it would be in the S&P relative to like its effect on it. Mm-hmm. I think there was maybe some overhang to the payout package that maybe limits the upside because it all goes into the pocket of Elon Musk rather than shareholders. But you look at this chart here.
That's baked in right now. I mean, it was into the pay package, expected to be passed. That's kind of baked into the valuation. Now it does make it harder, but we kind of knew that before. It does make it harder to reach the valuation because the valuation just needs to be adjusted back based on what they're going to be paying the executives. They're not the only companies that pay a lot of money. Palantir actually is another company that pays a lot of money to their employees, and they've been able to succeed in spite of that. So it just is going to come down to the performance. Can they meet these milestones? And if they do, it will all be worth it.
So, I mean, Joe, what do you make of this chart here at Tesla? If you look at some of the technicals here, obviously kind of had the flagging pattern in June and July of 2025 where we're making lower highs, higher lows, and then it broke out in September. Does it retrace this breakout or is it poised to move significantly higher?
Yeah, so the all-time high is about 490, 488, I think, Brian, would be the all-time high. So it is looking like it wants to kind of test that spot, maybe a little bit of a breakout here. If the market does have a good next couple months, I think Tesla will follow. Absolutely, it will be breaking out higher. It'll be part of this narrative of the AI. So yeah, I kind of think it's certainly possible that, but that's not to say it couldn't pull back. I think buying it here as a new initiation is a little risky. You got to look at the vol structure, Brian. Not surprisingly, it's very expensive. Looking at over a 60 vol. If you look out to January of this year, which I kind of think we're kind of set up for November, December, January, usually good months to be in the market. So I'm kind of just looking out there. But that said, with the upside kind of capped 488 being an all-time high, I don't see it racing through to all-time highs, maybe testing that. But I'm looking more at a cash-secured put trade here, Brian. Looking at the 450, which is only slightly in the money to be selling the put, and I can collect $42.50, so almost a 10% of a cushion here to be in this name here. So I can essentially be in Tesla at 408, 407 and a half, and be happy to be long it there. Or if we trade flat to neutral, I can collect all this premium, which is a decent chunk of change here.
Man, I mean, this is 10% almost of the value of the stock. So a 10% yield. If the stock closes above 450, you'd have a 10% return on your money in 2.5 months. So on an annualized return basis, is the ability is very high. Could be sold. Be willing to own, you said, down above $400 a share, because that's the different strike price and you collected from the put that was sold. So, maybe some traders, you would want to buy a 300 put or something, not to have like unlimited losses on the downside, because this is what this trade gives you. You do need to have cash to be able to buy the stock down just above basically $400 available in your account to do this trade. But this seems like a pretty good interest play. Maybe, I don't know, bring in some income. I like it.
Sure, yeah. For me, it's I think a lot of the promises that Elon has right now, they're still kind of in the future. I'm going to need to see, but if I'm going to see this stock race higher, I'm going to need some products to see some products launching and some success with those products before I think we get that next wave higher. That said, I think a lot of the hype can be starting to build if we're starting to talk about some of these launches coming in 26 and 27 that can build some anticipation. But in order for it to get to all-time highs, 500 plus, I'm going to need to see some raw data saying, hey, these are useful products. These are products that people are buying, et cetera. And, the margins on them are good and all that too. So for me, it's just kind of all hype story for right now, which is, that's okay. That's okay. But I really need to see the products. But I do believe they are coming. It's just a matter of when, not if. Which is why I'd love to buy it with the 407.5.
Right. So if you go to equityarmorinvestments.com, you can check out Trading Zone, and you can get these trades delivered right to your inbox every Monday morning when we do have a new trade on, but also updates to when we might want to take this trade off. We've been pretty successful. I think we're sitting at about around 65% success rate on our trades. So pretty good deal. Check that out. You can get more information about it if you write it to find out about it, but make sure you subscribe and check that out at equityarmorinvestments.com. Joe, you and I are here every at noon Eastern. You can sit and listen to us as you eat your, then chillax the second half of your hour break for lunch. Hopefully we give you some good pointers on the market started for the week. So make sure you tune in every noon Eastern on the Trading Zone here. We'll come see you next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.